So we're going to dive right into talking more about the implications of everything that James just introduced. And I'd like to introduce for you our discussion moderator. Kramer Mills is Assistant Vice President and Director of Community Development Analysis at the Federal Reserve Bank of New York. Claire leads a team that promotes economic opportunity by equipping community stakeholders with rigorous data analysis and the tools to make impactful investments. She initiated a Federal Reserve effort to gather intelligence on small business conditions, leading to the launch of the Fed's annual Small Business Credit Survey, a partnership of the 12 Federal Reserve banks. Last fall, Climate Safe Lending partnered with the New York Federal Reserve Bank on an event that explored the intersection of the climate crisis, finance, and local communities, where Claire masterfully moderated this complex discussion. So I put you all in the hands of a master as I welcome Claire to kick off this roundtable discussion of the role of banking regulators in a burning world. Thank you, Claire, and thank you to all of our panelists.
Elisa, thank you so much for that warm introduction, and I'll invite all of the panelists to show their videos. I'm Kramer Mills from the Federal Reserve Bank of New York, and I'm really glad to be here to moderate this important discussion about the role of financial regulation in the transition of the global economy to climate safety. We have a fantastic group of panelists, huge issues, and limited time, so let's jump right in. I'm very pleased to introduce 4 of the roundtable participants, and you all, of course, have met James. So beginning with the box below me in my grid, Stuart Mackintosh is the Executive Director of the Group of 30, an international financial think tank comprised of senior figures from central banking, the financial sector, and academia. Slavka Eley leads the Banking Markets Innovation and Products Unit at the European Banking Authority, which is responsible for financial innovation, digital finance, capital market union, and sustainable finance. Nick Robbins is professor in practice at the Grantham Research Institute on Climate Change and the Environment at the London School of Economics and Political Science. His work focuses on mobilizing finance for a just transition and the role of central banks and regulators in achieving sustainable development. And last but not least is Sandrine Dixon-DeCleve. She is the co-president of the Club of Rome, holds several advisory positions for the European Commission, and is a senior associate and faculty member of the Cambridge Institute for Sustainability Leadership, among other notable titles. So it's really my pleasure to welcome all of you. And to those who are tuning in, I'll just reiterate Elisa's prompt to submit questions and upvote questions in the form of a tweet. We're going to answer as many questions as we can during the course of this discussion, but we will get to those that we are not able to address today later on. And before we hop in, I am obliged to give my standard disclaimer that the views I represent today are my own and do not necessarily represent those of the Federal Reserve Bank of New York or the Federal Reserve System. So with that, I want to start with a 30,000-foot question to level set here. We have an array of folks who are on the line with us today. And to just begin, I'd like to start with Nick and ask, why are financial regulatory tools so important for a net zero transition? And then we'll ask everyone to hop in due course.
Well, thanks so much, Claire, and thanks for inviting me to speak today, and congratulations on the report. It's really thought-provoking, and I think a lot of really practical ideas. So your question is sort of, why are financial regulatory tools important for a net zero transition? I mean, clearly we need governments to act to shape the real economy, to get the incentives right, to support the new green sectors, to support a just transition. But we also need the financial system to be fit for purpose. And so I think there are 2 main reasons why financial regulators, central banks, supervisors really need to be taking an explicit role in the net zero transition. Firstly, is that the net zero economy is simply the best way of delivering the underlying mandates. So financial stability, safety and soundness of institutions and so on. Beyond 1.5 degrees Celsius, it's going to be increasingly hard to ensure that those missions of financial stability, price stability are going to be met. And the ability to actually influence the financial system is increasingly going to be out of the hands of supervisors. So financial stability is really the first. The second, I think, is also a profound one now, and it's great to see all the countries now putting forward their net zero targets, the US clearly, and China and so on, is that actually there needs to be policy coherence, and central banks and supervisors need to support the underlying economic policies of their governments. And that's clearly the case in the EU, where there's a treaty commitment for the European Central Bank to support the economic policies of the EU, as long as that doesn't interfere in price stability. So I think there's two fundamental reasons. One, financial stability, that actually financial stability is simply going to be undermined if we go beyond 1.5. And secondly, sort of policy coherence. And those two, I think, give a really good mandate for central bank supervisors to take action now.
Thanks, Nick. And I'm going to just encourage others, if you want to hop into the discussion, just give me a little bit of a finger point and we'll bring you in. We want to make this as, and Slavka, I was going to go to you next, so that's perfect. And then we'll turn to Sandrine after you.
Thank you very much, first of all, for inviting me here today. Yes, so no, what I would like to add, because I agree with everything what just has been said, but it's also that private sector needs to actually finance this transition, even if the leadership is on the governments, because only combination of public and private money can get us there. So we also need to get the financial sector on board, not just because it's the risk, but because those money are really needed for financing. The second point I would add is that it's also about risk materiality. So that this risk is really material. For that, we really need this regulatory framework to explain how that materiality needs to be assessed, because it's long-term time horizon in some aspects of these risks, which based on the current regulation and current risk models might not be showing what we need to see with this very long time horizon. So these are the two additional points I would add.
Thanks for that. And then I'll turn to Sandrine.
Yeah, I'll build on both of those points. And maybe as this is supposed to be the 30,000-foot question, I'm going to take an even broader perspective and just add that, first of all, thank you to the authors for naming where we are, which is in a planetary emergency, because we have to start from that perspective. And actually, it's completely linked to the work that we've done on the planetary emergency plan. So I really congratulate us in starting with that premise. What does that mean if we're going to look at an emergency? We need an emergency plan, and hence why regulators need to take this as an emergency. That doesn't just mean that we look at financing change. It means we also look at how we change the finance system to match. So this fit for purpose aspect that Nick brought up is so fundamental. Are our financial institutions fit for purpose to deal with, first of all, the convergence of tipping points that are making us in a planetary emergency, the health pandemic, the climate crisis, and nature and biodiversity loss? And then how do we account for that within our capital markets? How do we account for that within our lending structures? And how do we ensure that both the private sector and the public sector put in place the right fiduciary responsibilities and actual rules and regulations to enable that to happen? So I just want to underpin this very important point that we are nowhere near where we need to be in terms of capital shift to meet our 1.5 degree goal, to meet our Paris Agreement. We know that we need to do what is absolutely a phenomenal transformation of the finance sector in the next 10 years. And I would be quite provocative and say, I'm not sure we're going to get there, not if we're at the pace that we are now. Hence why this report is so important, because it puts in place those key mechanisms that we need to start to enable that real transition.
Stuart, so Sandrine, thank you. And Stuart, I want to pull you into this discussion, because I think, obviously, to have that transition that Sandrine is sort of throwing down here, you've got to have coordination across the private sector, the regulatory regime, and your think tank is a perfect ground for reflecting. Are the various parties that are so critical, are they ready for it, in your opinion?
Thanks. I mean, that's a good point, but let me first re-echo and emphasize what Sandrine and what Nick and Slavka said, which is this is an emergency. There's no time for incrementalism at this moment. That is why ambition is required. That is why, as Nick said, what we need is very ambitious governmental action to set the guardrails, to set the expectations, to shift the expectations. Because what we're seeing in some places and some markets, for instance, in the emissions markets in Europe, is a rapid increase in the cost of those emissions. And that's signaling to me that the markets are making the leap. They're anticipating the new normal. They're getting ready. They're already buying into the concept that carbon will be priced much higher. And so what the policymakers need to do internationally in a coordinated fashion is to confirm that reality, make big commitments, start monitoring them, start implementing them and ensuring that they're comparable and real. There are all these steps that we need to do to address the failures of the markets to include the cost of carbon. But I think I'm not quite as negative as Sandrine. I think change happens slowly until it happens very fast. Maybe 2021, maybe COP26 is the moment at which the slow change speeds up and the consensus flips. That's my hope, at least. I think it can happen. Will we limit it to 1.5? Perhaps not, but we still have to do it, even if we fail in that goal. Sandrine.
Sandrine, back to you.
Stuart, I love your optimism, and I tend to be an optimist too. I'm going to just put forward a few signals of great despair for the moment. What we just saw with Emmanuel Faber and predatory investment, and the fact that we were able to eliminate a CEO that actually for the first time was listening to the shift that was necessary, both from a social and environmental perspective, and that he no longer is a leader, at least for a very important nutrition company. So that's the first. The second is what's happening on the taxonomy right now. It was going to be our North Star at the European level, where we could put in place green criteria that would finally distinguish what we are calling green within the investment community. And it's an absolute bloodbath in terms of the political implications. Even though we try to look at science, we try to look at the emergency at hand. So I agree with you. This is a tipping point, but it also means that those of us who understand the ramifications have to be bolder and also more strategic in the offering that we have for regulators, for policymakers, and for the private sector in the way in which we move forward.
So I'm curious. I think Sandrine, a number of the clouds that you have just invoked here, I think raise questions about whether the frameworks, the reporting tools, the assets that we have at our disposal are the right ones, or whether we need to kind of really be rethinking how we operate and how we coordinate. We heard Eley earlier really invokes systemic interdependencies, and he also invoked the fact that the risks are nonlinear. And so, James, you also in your presentation, made that point. And so I'd like to offer that question for the group, because I think that this is really a moment to grapple with these questions. So do I have any takers for that one? Nick, please.
Yeah, no, I think that's really, really profound. And I think one of the things is the urgency, and I think this is a time-bound problem that we have, and we know we need to reduce global emissions by 45% by 2030, and that in a sense investment does precede emission reduction. Certainly in my country, the UK, the amount of investment in net zero needs to grow fivefold this decade. This is not a smooth slope we're talking about. This is a rapid transformation. And I think some of the things is that it's fascinating. I looked at recently, if you go through the TCFD disclosure, it doesn't mention net zero. It's so interesting. I mean, this is now a TCFD, as it's been doing consultations recently, but it doesn't mention net zero. And that's now the new North Star for our financial sector. So I think we do need to upgrade. We need an upgrade of the way we're looking at things, particularly to make net zero much more the sort of lodestar. I particularly like recommendation 4 in this paper, really thinking about net zero alignment and regulators being very clear about that, ensuring that all the firms that they regulate, the insurance companies, the banks, the pension funds, and so on, have net zero transition plans, and they're credible. and also obviously applying that to their own monetary instruments as well. But so I think recognizing that some of the things that were designed maybe 5 years ago or even 4 years ago need to be brought up to date with the urgency of what lies before us.
Thanks, Nick, and Sandrine, I'm gonna hop to you, and then I'm gonna pull Slavka into this discussion as well.
Yeah, we should bring the others because I've already spoken enough. I just wanted to add to that. I fully agree with proposal 4, but what I would also like to say is we need to get better at telling the story of proper risk management. So we're seeing that actually those companies that are ESG proof are the ones that actually have been most stable going through the pandemic. We also see those economies that have adopted a broader, beyond GDP economy through a well-being economy, that are looking at broader indicators and true risk management of their economies, have also come out much more robust post the pandemic. We're still in the pandemic, but anyway, as they move through the pandemic. And I think these are incredible examples of coming back to what truly then demonstrates proper risk management, and how we need to shift away from our predisposed idea of what that is, in particular in the investment community, and the way in which we can de-risk.
And thank you for bringing the risk management and telling the story aspect into this discussion. Slavka, I'm gonna kick it over to you.
I think James was already raising his hand before me, so maybe I will give him.
James, hop on in. We'll go to Slavka.
Sure. Go ahead, Slavka.
Sorry. So yes, no, I would like to follow up on what Sandrine said, and actually I was thinking to explain it from slightly different perspective. So let's say 3 years ago, when we started conversation with large international banks about the topic, or a smaller one, many times the conversation was starting around, this is a political agenda, it's the issue for the governments, risk is difficult to measure, it's difficult to prove that it's material. So, let's develop all the tools, have a perfect data, and then we can start modeling, and then we will see what to do about it. And at least from what we try to do, and I try to do in these conversations, and where the conversation has shifted by now, is to start speaking about, this is the risk which you don't see, but we all agree that it's coming, that it's becoming more and more material. So let's speak about how we can address and mitigate that risk. And then if you start the conversation from that perspective, then you actually end up in understanding that greening of your portfolio is one of the important tools you have to mitigate the risk. Even if you cannot measure it well now, you don't really understand all the implications at the moment, but that's the best tool you have. So these conversations typically then go into the direction that you need, on one side, develop and be innovative in the risk management and risk measurement methods on one side, but continuing with active greening on the other side, because before you will have the perfect data and perfect methods, it might be too late. So I also support that we need regulatory interventions in a way that indicate that more stricter and binding regulation is coming, indicate what is the direction on expectations, and let the sector, of course, gradually adjust. That would be, because also regulators cannot have perfect models and tools to regulate immediately everything and recalculate the buffers. Just let's look on how long it took to agree on Basel III and Basel IV. It would take regulators 5 years to have the perfect calculations, but be clear on these expectations and directions, and some indication on time can already bring a shift to the right direction.
James, over to you.
Yeah, thank you. I mean, I think just building on that, we have to acknowledge that whereas there's an overlap sometimes between managing an institution's own risk and managing the macro systemic planetary risk, there's also real tensions. So when you consider managing transition risks in your portfolio, you can do that in many ways. Well, one way is that you are really actively greening your portfolio and getting out of the pollution and into the green assets. Other ways, and Lael Brainard made a speech about this a few weeks ago, talking about, well, there's derivatives and insurance. There's ways of, well, we keep short tenure loans, as in a lot of fracking industry. Or even worse, actually using lobbying power to protect the revenue income from highly profitable, high carbon assets. So there can be some real tensions, and I think we have to acknowledge that. I read a report just before the beginning of the COVID crisis from Deloitte, and it was about the top 1,000 banks. And there's always a warning bell whenever you sort of say, it's like, oh, this is the most resilient that the banking sector has ever been. And then 12 months later, McKinsey is sort of talking about the COVID crisis, meaning probably about a third of global bank capital being written off. Very interesting reports and sort of simulations of stress tests about some of the carbon pricing and carbon tax proposals that Stuart mentioned earlier. It may well be that the order of magnitude, if you were to bring in something around about 100 euros, $100 a ton right now, might be kind of similar to what banks have suffered in the COVID crisis. But doing that has to be weighed up against what are the potential losses. And I know that LSE Grantham and Nick's colleagues done a lot of that in terms of the potential economic losses thereafter. And to Slavka's point, in terms of the imperfection of data, data will always be imperfection. The key philosophy is the precautionary principle, which is, what do we need to be doing given what we know, given that it's always going to be imperfect? And I think that's kind of the key emphasis what needs to kind of be accelerated in the next 12 months.
You know, to your point, James, I mean, we're getting some questions, really good questions from the audience. You know, one which asks, you know, about the next steps, you know, in terms of just assessing risk and whether or actually the credit rating regime that we have in place is actually appropriate and effective, or if we need to reconsider it. And I'm curious if anyone wants to hop into that.
I think if I might hop in there, I agree with that general sentiment. I think that would be one of the major ways in which, and is one of the major ways in which we can change the incentive structure, change the way that banks think about their risks, is when we adjust those risk weightings. I remember the chief risk officer saying this to me when we were doing our work for Mark Carney and Janet Yellen, and he said, look, tell me what my parameters are. Tell me what I'm dealing with. I will then go out and I can make my determinations. And we know that that is what actually happens when you give the regulatory structure, or you clarify the regulatory structure, having well understanding the fact that in many cases it still remains murky and some of the standards remains murky. But there's a hell of a lot of work that needs to be done on that space. You could have a great bang for the buck if we tighten that up and clarify it. And we may have to do several rounds of this. As Nick said, this is not a static process where we agree a standard and then we just let it sit for 10 or 15 years. No, these standards are going to have to be ratcheted up repeatedly, depending on where we are in the glide path to net zero.
Yes, go ahead, Nick. Hop on in.
Thank you so much. So yeah, and I think also recognizing that this climate change is the world's greatest market failure, that the market prices don't tell the environmental truth, then in a sense, we should not necessarily expect that the ratings given by credit rating agencies are going to actually reveal the full scale of the risks that different assets are carrying. So perhaps they do need something else supplemental is needed, not least because actually obviously central banks themselves will hold assets rated by the credit rating agency. So perhaps one thing we could have is, obviously you have the sort of market-based credit rating agency for the risks that are currently priced within the market or near term. and obviously many credit ratings agency outlooks are very near term. But you could also maybe include a requirement that the actual social cost of carbon should be modeled in a accompanying scenario as well, which would then give the investors this realization of sort of what's, in a sense, in the price, but also what the shadow risk that actually is there and is there in the environment, but actually cannot be priced because we have these market failures. So perhaps we need to supplement the current model with something that actually does reflect the social cost of carbon.
Thanks, Nick. Sandrine, over to you.
Yeah, I think that's an excellent point. And I think it's something that we've realized also now in the preparation of the second part of the taxonomy around looking at social indicators. But I think what Nick points to as well is that even though we need new financial regulation, we also need to remember that the investment community is also asking for policy signals in general. And part of that social policy signal has to be the way in which we make social policy more prevalent and also more transparent, and also that we offset the impact on society by taxing the externalities of pollution and climate change and enhancing their lives and livelihoods, so we don't get a gilets jaunes situation, because that will be the problem. So we need to get much better at that. And the last point I'll make is, through part of the work that I'm doing now as co-chair of the UN Food Summit, we're actually thinking about how do you start to offer global common goods, whether it's universal basic income or whether it's a global common good of food, which needs to actually be an essential for all populations rather than a commodity. Because if you de-commodify actually some of these essentials, that will also shift the way in which the investment community and the way in which we look at trade, the way in which we look at goods and products are evaluated with regard to the market economy.
So Sandrine, you've introduced just transition. You've introduced fiscal policy, intentional fiscal policy instruments, and I'd like to kind of tee up the conversation to turn to the interaction between fiscal policy and monetary policy. And for all the panelists, whoever wants to hop in, where do you see this working most effectively, and kind of who has the greatest learning curve? And I will remind everyone that my comments are my own and do not represent those of the institution I work for. Yes, Nick.
Yeah, thank you. I can't see everyone at the moment, so I have to use the old-fashioned wave the hand function. So yes, I mean, obviously at this moment with the COVID crisis, this terrible health and human tragedy and also economic crisis, we are seeing obviously the very clear linkages between fiscal and monetary policy, not least with the large bond buying, sovereign bond buying by central banks across the world. So I think at the moment, we have the opportunity to think through what a coherent fiscal monetary coordination could be, recognizing the need for central banks to be independent, and also recognizing that obviously central bank portfolios, like everybody else's portfolios, will need to be net zero by 2050. And so that there is a sort of a joint reason or a double reason why central banks should be thinking about actually both the corporate bonds but also the sovereign bonds they hold. If I may touch on, just build on that with the just transition, because I think this is one of the big shifts, and I think in the sort of the new climate policy we're now in the last year or so, is we now have Ursula von der Leyen at the EU, we have Cyril Ramaphosa in South Africa, and obviously President Biden in the US, all highlighting that the fairness and the justice of the transition is absolutely key for government policy. And I think it's interesting, again in this report, two proposals actually do touch on, as James was saying, this question of the fairness and the justice of the transition. One, the Bad Bank, and then the sort of upgraded sort of Community and Climate Reinvestment Act. So I think there's another thing perhaps that central banks and supervisors could do, for example, in the stress tests they conduct, really seeing if there are any sort of regional concentration risks, potentially sort of high carbon areas particularly at risk, or areas which are particularly at risk from physical risks, and think not just about sort of individual assets or individual institutions, but communities and regions and towns and so on that could be at risk of stranding. And I think that's another function that central banks and supervisors could play, which would require a response from national, local, state governments.
I'll just say, Nick, you raised, one of the, in my mind, very important roles and maybe underappreciated roles of central banks, which is that they're research institutions. Research institutions that have tremendous data assets that are often not widely accessible. And so in that regard, I think in some other aspects, one could say that there is potentially a tension between political independence and when you start veering into the implications for fiscal policy, but the research function, teeing up the analysis that then other actors can use is, I think, quite important and underappreciated. Slavka, over to you.
Yes, no, thank you very much. Of course, I am not representing a central bank, but I can share my views on the role of central banks in this effort of facing climate change and related risks. So, of course, central banks, as part of their monetary policies, they monitor all the relevant factors on impacting prices, because, of course, they care about the price stability. So it's obvious and clear that these new, let's say, environmental indicators are becoming or are already material to be considered in those models. So let's say you can intuitively understand that this should clearly become part of the considerations in the monetary policies. That's one aspect. And in that context also, of course, then that's translated into what assets they keep in their balance sheet, what is the vision for the future for those assets. And there actually is quite a lot of interesting work already done by the NGFS, for example, recently released a very good paper on central bank monetary operations, which is going into a lot of details. So where I would like to also make a point is that where central banks should be careful, in my opinion, is to speed an indication of the time frame for this shift, because if I think especially indication of the time frame, because doing certain things really fast can actually create additional transition risk. But what is important is clear messaging on the direction and on some time period for adjustment. And that can, in a sensible way, I think, really deliver shift, in addition to also what prudential regulators are already doing, what we were already talking about. I wanted to make a special point on the central banking function. Yeah.
Thank you, Slavka. Over to you, Sandrine.
Yeah, I just wanted to build on the role of the central banks, and you're absolutely right, this link now between the monetary and the financial policy and happening in sync. And we are seeing at the European level, I mean, look at the EIB that became the climate bank and started to really put pressure also on other MDBs to pull out of fossil. And I think that's fundamental, because it gave a signal that, first of all, it was willing to truly become a climate bank. It's actually now well ahead of the European Commission taxonomy, by the way. And it's using the original taxonomy as its basis. But then this gave a signal to Lagarde to do the same thing in terms of de-risking, looking at the ECB, the way in which they're looking at budgeting, the way in which they're actually linking their financial disclosure, and really starting to put full carbon accounting within their own thinking. And I think that's fundamental. The only thing I would add is that what we're seeing now in the recovery is that this is still not being taken on board with regard to the national banks, and also being taken on board at the policy level through the recovery. We were supposed to be at building back better or bouncing forward, because I would say you can't build back glaciers, so building back better is not really an option, but you can bounce forward. And what we're seeing is that there's still a lot of business as usual attitudes out there across the member states, where they're not actually linking up monetary policy or fiscal policy to really enable the shift that is necessary. And even though they're supposed to use some of their recovery funding for climate and also for nature, we're starting to see that there's a real complication in the way in which they do that. And there are two key reasons. One is projects. So demand, matching demand and supply is continuing to be a problem. And the other is they continue to claim that there's not enough data for them to properly evaluate. And I think this continues to come up, and we need to solve this problem, because it's wrong, but still it's being used as an excuse. And that's why PCAF, by the way, is so important.
Sandrine, thank you for those points. And James, I know you want to hop in, so go.
Just briefly, I mean, I really have huge sympathy for the roles of regulators, because as a sort of a function, it's like they're only really seen when things go wrong. And if you looked at the asymmetry between the fact that the data you've got to analyze mostly lives in the past, the jobs to protect when there's a crisis are in the present, and the risks are all in the future. And I think that there are some major questions in terms of climate where you kind of say, well, what's the legitimacy for a central bank to start straying into these political notions of managing the climate? Well, the rationale is given by the fact that financial stability is wholly predicated on it, but it does probably require, and I think, and Eley mentioned it earlier, and I've referred to it, this interagency working. How might, and in fact, it was, I mean, in the European taxonomy, in the original logic of it, it was to get an expert group guided by the science. The trouble came when it became political. How would it be if you had the EPA and the Fed working closely together, the Climate Change Committee, and Nick's been involved in doing some reports there, working directly with Bank of England and being able to set something which is like the pandemic. It's guided by the science and enforced by the appropriate agencies and arms of governments and regulators.
Stuart, I want to thank you, James, and I want to pull Stuart back into this discussion. I think that we've had some very interesting points raised, and James, you've highlighted essentially that kind of the tension, the time horizon tension, right? Stuart, from your perspective, as you look to the timeline that we've all invoked here, which is less than a decade, right? Where do you see the greatest potential? And this can appeal to the 10 proposals, or you can take us in a different direction. But I'm curious, where are you putting your optimism at this point?
Well, I think, yeah, that's a good question. We are under huge pressure to act quickly. I'm actually a pessimistic Scot, but being in America now, I have to slightly be optimistic on the design. So I'm being slightly optimistic. I'm assuming that there will be some very significant steps at the upcoming virtual summit led by President Biden, and at COP26. I expect there will be major commitments. There will be the Indians are committing, of course, and then China's already made a commitment. I expect that they will improve on that, and I know that internally they're working very, very hard on laying out their plan, and we know that China can, when they really try, can make very large leaps very quickly. So I do think it's possible, but it's really going to be about the speed at which, and this is going to your fiscal policy question, the speed at which we can utilize and the effectiveness with which we can utilize fiscal policy as well as monetary policy, but fiscal policy in terms of a green industrial policy in America and in Europe and elsewhere, to accelerate the rate of growth, to pull forward the rate of transition and the decline in greenhouse gas emissions, basically to speed the diffusion curve, to steepen the diffusion S-curve for the new technologies that we have to adopt in the next 10 or 15 years. It's a combination of all these things. It's not, as our opening speaker said, it's not one thing or another thing. There are no corner solutions to the global climate crisis. It's every single lever needs to be pulled. It's the monetary policy lever by the Federal Reserve Board, which is finally being pulled. It's the fiscal policy lever that's being pulled by President Biden and others. It's the regulatory guardrails that determine and change the expectations and the trajectory going forward. It's the leadership of corporates and the leadership of CEOs who really internalize the goal of net zero. Because you can tell the difference when you see a CEO who really understands it and believes it, and you then talk to another CEO and they're just talking about it. There's a fundamental difference, and we've got to accelerate that diffusion to pull forward the benefits before we hit the climate tipping points that will take us to a new hothouse world, and there'll be no going back.
There's a really interesting comment that was just submitted in the chat. Winning slowly is the same as losing. Can you comment on how going slowly will actually add risk to a sudden and disruptive, destabilizing economic shift? And I guess I'm gonna piggyback on this question because we have a limited amount of time and I want to do a bit of a lightning round. So I'm going to turn to each panelist in turn, but the big question is, what do we have to get right in the next 12 months? We've talked about kind of a decade, forget about a decade. Every moment counts, right? I think you've convinced folks tuning in and a broader viewership. So I'm going to start with you, Sandrine. What are we looking to? What are positive signs that we need to see in the next 12 months from your standpoint?
I'm gonna answer Lee's question, or try to.
Okay.
The first thing is winning slowly is the same as losing. I would say that's why we need short-term levers for long-term systems change. And we need to be smart around what those short-term levers are. So yes, if we go too fast and we get the entire planet becoming gilets jaunes and the entire population pissed off and becoming populists, we're not going to have the leadership we need and we're not going to be able to move forward. But if we're smart enough and strategic enough to put in place the right levers and think through the social and environmental impacts at the same time, I think we can do this. And we've shown through COVID that we can transform. We have to tap into the consciousness of everyone, that it's their lives and livelihoods that's the most essential. And we've got solutions to ensure that they are happy as they move forward and they have lives and livelihoods. And to come to your point, Claire, I would say the most important thing is, one, get the taxonomy right, because that's sending a signal to the rest of the world that we can start to put science-based criteria on investment. The second is we have to have an ambitious COP26. We have to get this. Everyone is waiting for those signals from policymakers across the globe. And I would even say a third really important point, and it's not completely linked to this, but it is, debt for nature swaps, and we need to do it fast. If we allow Bolsonaro to continue to decimate the Amazon forest, we're all doomed. What does that mean? Figuring out how we can pay for the nature that he has that's our lungs. And that's part of the monetary and financial policy that we need to get right away.
Thanks, Sandrine. All right, lightning round. Slavka.
Sandrine already raised a very good point. So I also was going to make that point on taxonomy to really, and also maybe try to agree globally on something what could be an equivalent of taxonomy at the international level, because of course having only EU framework is it's too little. It's a lot in Europe, but too little for the overall shift we need to achieve globally. And then what has not been mentioned is disclosures. And if we can really get much more done on corporate disclosures within the next 12 months, that will make a significant change in data available to improve understanding, modeling, and all the issues financial sector need to deal with, and regulators. So really to get the disclosures of both corporate and financial entities right. And I think we are, at least in Europe, on the right way with that, but it could also be done more at the global level with the TCFD and reactivation of maybe going further with corporate disclosures.
Thank you, Slavka. Nick, I'm going to turn to you next.
Yeah, thank you. And fascinating discussion. So maybe three things, if I may. Firstly, next 12 months, I think central banks and regulators need to be very clear and explicit their role in how they're going to support the net zero transition. Many ideas discussed today. A report I did with colleagues, Net Zero Central Banking, sets out a lot of ideas on that. And I think what is interesting is that we see the first fruits of that. So first, sort of net zero central banking regulation. The second, maybe building on what Sandrine has been saying, is broaden this, not because we don't think the regulators have enough to do, but actually think about the broader nature and biodiversity crisis. And I'm co-chairing a new initiative with the NGFS and the Inspire Research Network to look at biodiversity and financial stability. And then third, if I may, I'd just really like to pick up Stuart's point, the broadening to the global agenda. I think it's very profound when you think about it. My country in the UK peaked its CO2 emissions in 1973. The EU peaked in 1979. The US peaked in 2007. So 77 years for the UK to go from peak to net zero. For the US, 43 years. China is yet to peak, and they're aiming to peak at 2030. They're going to have 30 years. India. So we've got to think the biggest transition issues are in these countries where they clearly have major development needs. Huge opportunities, because we know the alternatives, renewables and smart and so on, are so much better than the incumbent technologies, but really recognize that these countries have an immense challenge to meet the goal, which is actually much harder than the industrialized world.
Those are really important points. Stuart, I'm going to go to you next, and then we'll close with James.
Sure. Well, I'm looking for big ambition, major announcements to shift the incentives and shift the expectations of markets. I want to see mandated TCFD, because I want all companies, large public companies, large private companies, to have to be transparent about their carbon intensity, so that the large number of investors who want to take that into account can do so. I know there are issues around taxonomy, of course, they need to be addressed, but nonetheless, I want to see mandated TCFD. I want stress tests in all major institutions, and I want to see commitment to pricing carbon. I don't so much care about whether you do it through a cap and trade system, which works quite well to a limited extent, but in the EU, or through just taxing carbon straight, which they've done very successfully in Sweden, which they're doing in Canada. It is not the end of the world as we know it. And if you do it and structure it in a revenue neutral way, you can avoid the gilets jaunes situation. And finally, I completely agree with Nick. This has to be a just transition. So that means resources and technology transfer have to occur to the lower income countries that must make the leapfrog to green assets and green investments, and miss out on the polluting ones that we've left them with.
Thanks very much, Stuart. James, I'm going to close with you. And you were a co-author of the report, and so you kind of get your own special question if you want to answer it, which is which of the 10 proposals is your favorite?
I'm not sure. I think that both the proposals 2 and 4 kind of go together, because what I think the winning slowly paradigm is all about area under the curve. Disclosure is entirely necessary, and I'm hopeful that there will be the momentum to get TCFD fully mandatory, but it's 40 months until 2025. If you look to the carbon sort of countdown at the moment, it's maybe as few as 80 months existing emissions levels before we blow through the carbon budgets of 1.5 degrees. So we can't wait for the necessary disclosure in order to start actually acting. I think that the really interesting thing, and in terms of net zero regulation, which would mean enforcement through things like the capital risk weights, is that you've got voluntary things. TCFD was voluntary, carbon accounting has been voluntary, but you realize that suddenly it makes normalized practices which can be picked up by regulators and say, oh, apparently this can be done now. It should happen for everyone. We need to reduce the time from flash to bang in terms of getting these voluntary set of things with the right rigor, with the right congruence. We can't allow ourselves to be distracted with, spurious offset kind of things. And we need to focus on the biggest thing to focus on in terms of global sustainability are the things which are causing the most problems now. So you need to have the taxonomies and the direct action on those assets which are causing the most problems. But I think that there is the intention. There's a G7 and COP this year. There's a lot of hope and a lot of high stakes now, and I think that it's got everyone's attention. It's great to see the US back, so I'm really confident and optimistic in being able to push some of these through in a short time horizon.
Well, we're going to close on that optimistic note and just say that those are important focal points for everyone to kind of be paying attention to as we move forward. I want to thank all of the panelists for a rich discussion in a very, very short time frame. So with that, thank you. And I'm going to turn the webinar back over to Elisa.
Claire, thank you so much for moderating this engaging roundtable discussion, and to all of our speakers. I'm going to ask my team to put up a copy to see how the poll, what you all said about the policies that we have to move forward on. And clearly what we heard today from all of our speakers is that there's a growing consensus among a wide diversity of actors across the financial sector for bold climate finance proposals that are not currently being fully implemented. Or as Sandrine said, there's no time for incrementalism. We've got to collectively and collaboratively step up our game. So our presenters today and our advisors for our paper on financial sustainability, financial stability in a planetary emergency, and all of you have identified that some of these key opportunities include getting tougher on buffer, policing the journey, leaving no one behind, that is a just transition, and sending a big green light signal for lending. All of us at the Climate Safe Lending Network would like to extend the conversation about how these proposals can be refined, improved, and considered for implementation. We'll be planning wider dialogues and collaboration for action in the months leading up to COP26. And collaboration for action is the underscore I want to make there. And just to give you some quick highlights on how you can take action with us, join our Climate Safe Lending LinkedIn group to share your reflections and how you're going to move forward and how you're ramping up your actions. If your focus is on banking policy and regulation, please join with our work at the Climate Safe Policy Initiative. We're going to be gearing up a Climate Safe Regulatory Lab, and we would love you to co-create on that. Again, extending the dialogue and taking action are the themes there. If you work inside of a bank, please join with our Climate Safe Learning Lab. This is a confidential learning space for banking professionals to figure out how to up the game internal to banks. And if you believe that, as we do, that this is a pivotal moment, that across the banking system, banks are making serious climate commitments, and yet at the same time, as our panels pointed out to us today, the climate emergency is deepening, so that together we need to go further, faster. You may be interested in joining our next Climate Safe Lending Network on May 18th and 19th. If this is something that you're interested in, please send us an email, post it in the chat. This is truly an immersive experience that gets beyond the technicalities of climate targets to address what it truly takes to align and take action. All of the banking system stakeholders together. As a reminder, the webinar recording, the link to our report, Financial Stability in a Planetary Emergency, and links to the discussions in the chats will all be sent out afterwards, as will be the responses to all the questions, all the great questions and insights that you had today that we did not have time to get to. Our post-session Q&A reports are very, very popular, so please look forward to that. Thank you all for attending today. Thank you all for joining us. Thank you for the work that you do to address this problem with speed and scale, and have a great rest of your day.